Welcome back, everyone. As always, I'm Nick. We've got Luke with us here today, and this is Verticals. We have a great show for you today. We're going to bring on a titan of vertical software, Sam Youssef. Sam is the founder and CEO of Valsoft. And you may not have heard of Valsoft, but you really should. They are one of the biggest vertical software aggregators out there in the tradition of Constellation software. They have over 3,000 employees. They have 700 million plus in revenue, multi-billion-dollar valuation. And he's going to share with us today everything he's learned about buying, building, growing vertical software businesses. He's done over 130 of them. And stick around to the end because you're really going to want to hear his perspective on the future of AI and vertical. So with that, let's dig into the vertical pulse, and then we'll bring Sam on.
All right, let's do it.
Let's do it.
I love it. So knowing that we've got Sam from Valsoft joining, I thought it would be great to kick this off with some recent news. Beacon Software, which is similar to Valsoft in the sense that they're out there buying a bunch of software businesses. I think most of those are vertical focused. It's the founder's the ex-president at Instacart, and he calls it anti-private equity roll-up. So kind of interesting. Private equity has such a bad taste in so many founders' mouths, and so this is a smart strategy. I think he started a little over a year ago. And, the thesis was let's go buy some businesses and really, lean into them operationally and support the transformation. And you can see General Catalyst just led the round, $250 million. I think what I've kind of heard with these GC deals is a lot of this is debt. I can't say it is or isn't, but that's just kind of what I've heard how they're structuring these things. Because if you've only been around for a year and maybe you've bought in a couple of businesses, shoot, the valuation's got to be sky high for that to all be equity. But I don't know. I'm not saying it is, to be clear, but nonetheless, like monster around here. So pretty interesting. Nick, this is a departure from GC's focus on like service business roll-ups. So curious to kind of hear what you think.
Yeah, I mean, look, I think a big part of it is driven by the fact that, GC has a lot of money to deploy here. And I mean, that's not to say that they're not brilliant folks, because I think that should be taken as a given. But I think it just speaks to kind of the scale of the opportunity. You've got tons of companies that are maybe not AI high flyers. Maybe they're not going to get to, kind of venture scale. Maybe they weren't targeting that sort of outcome to begin with. And, that's maybe not the ecosystem of high flying strategic acquisitions or IPOs. What do you do with those businesses? A lot of them are sitting around with all founder equity or maybe tied up in other PE firms. So, roll them up, get some economies of scale on that multiple, and, here we are. But I think it's a really interesting one to watch, and slightly different model than, Valsoft and that we'll hear from today, Constellation, et cetera.
And maybe I'm wrong because it says it valued it at $1 billion. So maybe it is all equity. Damn, good for them.
Yeah, I think there's also the separate question of how Beacon is valued, and then, how they fund and value their own companies. But yeah, no, that's a cool one to watch. Awesome. Well, with that, Luke, should we transition into some kind of interesting fundings we ran across here? Yeah, Luke, tell me more about this one.
Yeah, so next up we got a couple of funding announcements. So StreetBeat just raised $15 million. It's one of these kind of AI agent for, X platform. These guys are focused specifically on wealth managers, which I think is kind of interesting. So first, the crowded space, tons of software stuff. I remember looking at this industry more broadly, and there's so much competition. I don't know if they're the first to the party as like a solely AI, agent platform for these businesses, but kind of interesting. They say you're Jarvis for finance. I like it.
Interesting. I think I can say with confidence they're not the first, at least if you're going to talk about AI and private wealth. I mean, I think Adipar raised $230 million in a very growthy round. I think it was Vitruvian and AVC and stuff. Now they're not AI native per se, but they've been in and around in this space. Who else? Like Altruist, Wealthbox. I mean, there've been a lot of these, but to be fair, AI native is kind of this new generation. So maybe they're doing things differently.
First AI native. I don't even think they're probably the first AI native. This is such a big category. I see new stuff here all the time.
Yeah, exactly. I think it always sits as a very compelling like vertical software market because there's a lot of money. There's a lot of money flows. So that's a pretty cool one. So I want to talk about Chip Agent. Chip Agent raised a $21 million Series A recently. So that was led by Bessemer Venture Partners, had a couple other insiders and actually two strategics, Micron, as well as Ericsson. The business overall, it's an agentic AI startup, and they're focused on chip design. And so, for maybe those novices in the space, we're talking about chips in terms of semis. So, chips that are going into your GPUs, powering your chat GPT, et cetera. And they sit on top of, basically, if you think about electronic design, EDC overall, it is a mature software ecosystem. So you can think about Cadence, Synopsys, Siemens, and basically what these solutions do is they help with the overall design, the design generation, the testing, the debugging, the verification. Because obviously these are very strenuous, like high failure mode designs, right? And at this point, the additional throughput we're trying to squeeze from these chips, every marginal, basis point step forward is a huge win. But it's a very time intensive process. Also, a lot of the expertise that goes into it is somewhat aging, right? These engineers have been around for a long time. So Chip Agents is taking a different approach. They sit actually on top of the cadences of the world, and they have kind of multi-agent workflows to parse, kind of really long specs lists to kind of triage issues. And, at the end of the day, to kind of perform root cause analysis on, hey, is this chip performing as we designed it? So I thought it was a really interesting one, not just because it was a great round led by a great firm, but, because there's obviously a lot of investment going into this space. We talked recently in our last episode about, the quote unquote infrastructure bubble, if you consider it that, really just all the dollars going into data centers, right? The core thing going into that data center and making it an asset is, are the chips. And I think a lot of the growth in AI that we're all underwriting, this path to AGI, if you will, is predicated on continued advances in performance of our semis, of our silicon. So, Luke, what do you think about this one? How do you think about this space?
I love vertical software for this space, just from the sense that, it's kind of an emerging industry. I mean, obviously there's a bunch of like existing legacy giants that have dominated kind of energy and the precursor to this that are probably best positioned to take advantage of it, but creating like kind of an AI like software layer to help those businesses run, a much better process in this new era is really, really compelling. So I can see why there's money going into it. I think the one part that worries me about this space is it's got to be super enterprisey from a sales motion, right? There's not a lot of, I would imagine, the segmentation is like very top heavy.
Yeah, I think that's right. I mean, you also, it's kind of like, selling extremely complicated, design or engineering software in general. You don't get like kind of like in the industrial world, you don't get like a JPL to switch gears quickly. And I think it's very similar. You have a lot of engineers that have been working with the same EDC software for decades. And I don't think you can really access the market without figuring out some sort of like partnership, layer on distribution strategy alongside, the cadences, the Synopsys of the world.
No, but it's obviously heating up because this other one I just pulled up, Chipmind, just came out as well. Looks like to be doing something pretty similar. So raised a lot less money, $2.5 million, to launch AI agents for faster chip design. So, obviously a lot of activity going on here, but excited to see this. I think the fact that Bessemer is behind Chip Agents is, always a good sign. Those guys typically don't miss in VSaaS financings.
Yeah, no, it's definitely heating up. I mean, I think recently there was Cognichip and Etch. There's a bunch of interesting ones to track in this space. So to take a look. And yeah, Luke, you had one other interesting kind of space you want to touch on today, right?
Yeah, so it's very different than AI chip design software, but I just thought it was interesting. So it looks like a company called Magic just announced a $10 million seed round, and it's focused on loyalty software for restaurants. It just made me think, do you remember like 2010 when there was so much going on around loyalty stuff? Like it was almost insane. Every time you walked into a restaurant, there was like a whole like kiosk thing of whatever kind of loyalty software company was hot at that time. I just remember a huge explosion and a massive amount of grave sites not long thereafter. And so just wanted to highlight this because it seems like these guys are loyalty is potentially somewhat back.
What was that company where, was it could have been Foursquare or was something similar to Foursquare where you like competed to see who was the mayor of your local coffee shop or whatever,
Yeah.
you know?
I remember what you're talking about. I can't remember what the company was.
It's like a set.
That era was so like interesting because all there's so many massively funded players that like I don't think any of them stuck or like I don't see them anymore.
Yeah, I mean, I think Foursquare is still around, but it's almost more like a location data play. I mean, social mobile local, man, it was a different time.
Yeah.
But I mean, there were some great outcomes, right? But I think they kind of got more subsumed into kind of restaurant POSs. I think that's where a lot of the successes lied, is the ones that actually got like point of sale distribution. There were a couple kind of, call it $1 to $500 million exits, but it is interesting to see. I mean, it feels like feels like consumer is maybe in an upwave with this era of AI.
Yeah, interesting. Well, we covered all the bases. So we got Beacon to start, vertical SaaS for AI chip design, and then some loyalty tooling for restaurants. So a lot going on in our pulse this week. But I'm so pumped to invite Sam on. It looks like he's knocking at the door. So let's get him in here.
All right, everyone. Super excited to introduce our guest today. We have a great interview and show lined up for you. Sam from Valsoft is joining us. He's going to talk about everything vertical software, vertical AI, where the puck is headed. Luke and I have had an opportunity to hang out with him over the last couple of weeks, get to know his business, and you got to stick around to the end because it's a super exciting one. So, Sam, thank you for coming on. We want to pass it off to you. Why don't you tell us just a little bit on you, on Valsoft, and we can go from there.
Thanks a lot for having me, guys. And so a little bit about me, Valsoft. So I'm a lifelong entrepreneur. I started shoveling my neighbors' driveways when I was a teenager. And then I contracted a bunch of people and I grew, and then I did some other businesses. And around 2011, I started an investing company called Valsoft Capital with a little bit of the money we had made along the way. And I read a book called Snowball. It was like the story of Warren Buffett and like his life up to that point and how he created Berkshire Hathaway. And I got really I'm like, man, I want to live. I want a career like that in investing and deal making and building companies, buying companies. It looked really interesting to me, and that led me to read about a lot of other investors and business biographies and stuff like that. And I started this investment company called Valsoft Capital. At the beginning, what we were doing is we were buying value stocks. I thought, this is like what Warren Buffett did, and that's what I'm going to do. I'm going to buy cheap stocks, and then they're going to go up, and I'll make money. And I lost a bunch of money doing that. It wasn't working. We weren't doing well. So then we adapted, and we kept learning, and we kept at it. And we started buying stocks in better companies, and we're like, if we are gonna put our money and not have control, up until that point in our careers, we were entrepreneurs and we always had control. So we're like, we're gonna select companies that are really well managed. We're gonna buy companies that are in the hands of very good management teams that have high predictability of revenue, that have mission criticality with their customers, that have pricing power, and that have a lot of characteristics that make them a very good business where they can't easily be shaken given all the bad experiences we had buying cheap stocks. It guided our investment philosophy, and we started going towards well managed quality companies. And at the time, we're talking 2011, 2012, I just, not by design or anything, but we started buying software companies in the public markets. And, it led us to invest early in some of the companies that would then go on to do very, very well. It was the SaaS sort of a boom. And a lot of the software companies that were around in that era did very, very well over the ensuing 4 or 5 years. And Valsoft Capital took off, and we started doing extremely well. We ran into a company called Constellation Software that part of our public market investing strategy. We ran into Constellation Software, and Constellation Software was ran by this iconic founder, legendary sort of person in the field. And I learned a lot listening to him and reading what he wrote and whatnot. And and it became our largest position, very large position for Valsoft Capital. And we're like, man, it's really interesting what we're doing. We're entrepreneurs. We're also investors. I would love to see, if we could do our version of a software acquisitive firm where we just want to buy one company and see how it goes. And we bought one company in South Florida. It was a hotel management software, and we did extremely well with it. So using these cash flows and a little bit of the money we had made in the markets, the year after we bought three more companies, and the year after we bought five more companies, and the year after eight more companies, and like fast forward to 2022, some of the largest institutional investors in America backed Valsoft. We took it to somewhere around $200 million in our own with our own capital, and then brought in some external investors, and then like took off. Today we have 130 companies, over $750 million in revenue, and the company is doing very well and growing. And throughout the history of the company, it's been like the same, right? It's buy good companies that have a good presence in a market that is structured rationally, uh, where these companies can have enduring good economics, and likely companies that haven't been around for decades, and then look for ways to grow them, and generate operating leverage of that through that growth, where on top of growing them faster, we could generate a good profitability, and then use this profitability to reinvest in either organic or inorganic growth based on what opportunity exists in that market, right? And that's what we've been deploying successfully for close to for over a decade now. We had 10-year anniversary this year.
Congratulations.
Congratulations.
Yeah.
Thanks a lot.
Yeah, it's been an amazing story to track. Obviously, one that looms very large in the vertical world that Luke and I know and love. But Sam, I wanted to just get a little bit more color for our listeners here. So a lot of them may be familiar with Constellation, right? Their playbook tends to be go after lots of small companies. You can acquire them for very reasonable prices and grow them. In terms of size and kind of just type of company you guys look for at Valsoft, how does that compare to Constellation? How does it contrast?
We look at buying companies between let's say right now we're and eventually buy bigger companies, but as far we're a little bit scared of concentration risk within our portfolio, so we try to stick to companies between 3 and 100 million right now. This is where we're looking, and we're looking for companies that have like strong fundamentals. So if we go on the smaller side, let's say the 3 million, the problem becomes you don't have enough revenues to like have a large enough R&D budget to sustain your market position in a lot of times. So sometimes the larger companies have more staying power and more ability to protect and expand their market share because they have a larger budget chasing a certain customer base. But if the industry is small, if like it's a very small market, like if you're dealing in the forestry market, let's say, or something like that, which is small software market, then the small company could be fine, right? If you're dealing with in a bigger market like the medical market, you probably want a bigger company because you're gonna have to have a bigger R&D budget to compete against the incumbents and the VC-backed companies and whatnot, if you want to protect and expand your position.
When you think about what you're buying these at, and then what Valsoft as a whole is trading at, I guess where did that look in the early days, and where has that evolved? Is it kind of, now that you have the scale power, there's probably like a classic arbitrage the moment you acquire. Kind of earlier days, maybe a little bit, just given you and the team's background, right, versus the companies that you were buying. Like how has that evolved over time?
I mean, so our average multiples have stayed relatively the same. Thing is that we gain prominence as an acquirer, right? So more deals come to us. People feel more comfortable being with us. Often we're the preferred buyer because people know we're going to close a deal. But we've bought businesses for one time ARR, and we've bought businesses for 10 times ARR if it's a product that we really want in an industry that we're involved in, and we know we have a large a stable of customer that could benefit from that, we'll pay a lot of money for that. If it's a declining business where it's basically gonna hurt our organic growth profile, and like we're gonna have sort of scramble and invest in rewriting a product that has a lot of tech debt, we'll pay a very low multiple because there's a lot of risk inherent in that transaction, right? So where we come into play is that we're a very operationally able company, so companies that like uh, need a boost in terms of let's say they're tapped out in their market, and the best thing for them to do is acquisitive growth, or a company needs professional operators to come in and help it with the next phase of its growth. So we bring that to the table, right? Because we've done it 140 times. So that's like many different subsets of mistakes that you've made along the way, and you learn exponentially from 100 something different subsets of mistakes, and that knowledge compounds, and you get to have a good instinct to how a company can improve its position. So the average company within the Valsoft ecosystem grows meaningfully in the 18 months post acquisition, because there's usually things we could do to trigger meaningful revenue growth.
And so like in Constellation's example, a lot of what they're doing, it doesn't feel from an outsider perspective that they're doing a lot of like operational tweaks outside of raise prices, try to get to some like 30%, I think is what they target on an EBITDA margin basis, and then just let the company, maintain at least some level of growth rate. You guys are much more hands-on. Like that's one of the key differentiators that you saw, I'm assuming early, like with payments and all these things that you can add to really juice it. Is it totally deal by deal, or do you guys kind of look at like how do you get that growth you're talking about?
No, we have like 7 proprietary like sort of integration playbooks, and these are things we discussed with the founders prior to selling us the business. We're like, we think we could do this, and there's usually a reward for that. So like some of the things we do is that we'll come in and we have our own payment infrastructure that we'll bring on board and try to like bundle in payments. We try to, obviously now it's the era of AI widgets. So there's, in most industry, there's sort of 1 or 2 or 3 successful AI applications that you could bring to the table and meaningfully increase the AR. There's usually also like products that are already in the markets, traditional software products. We have very large development centers in Sri Lanka, India, and different places where we could bring in 20, 25 developers to an application and revamp it, eliminate the tech debt, so that we could iterate faster on features and new products that are needed in the market to compete. So like when we'll buy a company that is maybe losing market share, well, that's what we're going to bring to the table. So we have different operational playbooks that we've developed throughout the years to help the companies.
What's like the most badass success story of kind of pre and post acquisition? Like maybe you guys bought something that was declining and added like payments and juiced it to 30% year-over-year growth. Like what?
I'll tell you our first acquisition, the very first one. So a very, very reputable hotel management software company owned by the founder, and the founder wanted to move to California, and for tax reasons he needed to sell his business, and anyway, the business had been like sort of flat for a certain period of time, and but it was a very good business. It had like thousands of customers globally, a leader servicing the boutique hotel market, and we bought it for $5 million, and it was making like a mil something of EBITDA. So it was a good business. We bought at a good price, stable, slightly declining market share, but had a good product suite. And I had no idea how to run a software company. I'd never done that in my life. I had run some investing operations, some web operations. Never ran a software company. So my plan was, to just collect the money, see what we could do, tweak it a bit, bring the million and a half to a little bit more than that, and see if we could generate a very good return. And there was a manager in place, and my plan was I'm just gonna keep this manager, and I'm gonna sort of be the chairman of the company. And 2 weeks later, he tells me I can't do this. I'm quitting. So now I bought this company in Tampa. I'm in Montreal, and and there's nobody to run it. So I go in there a little bit, check things out, learn what people are doing in the software company, get involved, and I bring in one of my old colleagues and friend, Michael Assi, came in as the president of the company. I worked with him, and we started working on this company. A year and a half later, this company that we bought for $5 million is making $3 million bucks of EBITDA. So we're able to significantly improve the company, and starts growing its market share and offering more products to its customers. Today, this company makes upwards of $10 million of EBITDA. That the director of sales at that company, which eventually ended up running the company and growing a portfolio, like the hospitality suites that was built from that core, is over 50-60 million dollars of revenue, and it's an extremely successful portfolio for us.
That's amazing. So most of it has come from product expansion. You guys were adding a bunch of, outside of like you guys getting in from an operational standpoint, you guys built a bunch of net new products that you sold into the base.
That's it. That was our strategy. Was this company, and so a lot of them were already there. We just sort of added a little bit to the development. The old owner did a very good job, ran a very lean ship, and had a very good company. But maybe their desire to invest wasn't the same, given that they wanted to get out, as an owner that comes in and has a multi-decade view of things. Is we're going to invest differently, right? But it didn't take long for things to improve materially in terms of revenue growth, and all the increases in profitability came from revenue growth, right? Company has, if you look at just that piece, it has, many more people working there today than were at the time we bought the company.
Sam, would you, based on your experience leading across hundreds of these, vertical businesses, would you agree with, this statement that we commonly hear? It is always easier to sell more products into the same people as to sell the same products into new people. Is that, commonly how you guys see growth post-acquisition?
I mean, for sure, especially if you own the system of records, that's much easier for you to sell into your base. But often this is the lazy way a little bit, and it leads to eroding market share over time. Certainly, if you have opportunity to sell things into your base, that's the most profitable thing you can do. That's the smartest R&D dollar, and that should guide how you invest, right? Both in sales team and whatnot. But you should also have a company that ideally gains market share, right? Else, you're not going to have much of a company a few years down the line. So we want our companies to, through listening to customers, develop what the customers want, and that should help us gain market share too, right? One doesn't go against the other, right? But also, happy customers will give you a good reputation within your industry, and it's going to lead to you gaining new customers. Because these guys, the GM of these businesses, move from company to company, and they bring in their software vendors. And if you're sort of a superior product, likely you're going to be a market share taker.
What's the failure rate look like? How often do you guys screw up an acquisition? Because I feel like I love these aggregation businesses in vertical SaaS. I've heard multiple times that you just can't screw up the first couple, and then you have obviously you never want to screw up any, but you have some more rope. How does that look, and where's the line that you need to to walk to?
No, we have I don't know if I call them failures, but learning experiences that
Yeah,
we've
that's a
had
better
over
word.
the years. That we've had over the years. There's many times, if you end up dealing with people of low integrity in an acquisition process, the person selling you the business knows a lot more about the business than you do, and gauging the quality of your counterparty in any transaction is vital. I think, like, if you're not comfortable with the culture of the company, if you're not comfortable with the people you're dealing with, regardless of what the numbers say, people are good at making things look good on presentation and on decks, right? It's people of high integrity build businesses of high integrity, and vice versa. And we've screwed up a lot over the years. Certainly, we've had a lot of learning experiences. We've bought a lot of subscale companies that deteriorated with time. We bought a lot. We bought a lot of companies that had customer concentration, where we lost the big customers, and we ended up in a bad spot. But we've had also a lot of companies that are like 10x what they were when we bought them.
Is it like 80-20, Sam? Like 90-10? Like, what's the line you have to walk?
Yeah, you have to. Depends on how successful your successful ones are, right? Like in our case, maybe 25 to 35% of our acquisitions we've had outcomes that are below our expectations, and then we've had other maybe a majority of our deals where we've had outcomes that are better than our expectations. Right?
One more question just about kind of how you guys run your operation. Then I do want to make sure we have time to get to, I think, the big questions around AI. But how, as I think about running also an investing business in a vertical, the vertical world, I have we have a unique approach to sourcing. I'm sure you do too, but I'm sure it's very different. What is your biggest channel for sourcing deals? And yeah, I mean, I'd just love to learn about how Valsoft does it.
Yeah, Valsoft has we have over 100 people looking for deals in every corner of the world. We have people in most areas of the world looking for opportunities. I think we have people in 25 different countries right now. And then in the US and Canada, we have a lot of people that sort of cover internationally as well. So we just have a database of people that we keep a relationship with, and if somebody has a vertical market business, odds are they've spoken to one of our M&A folks or one of our operators over the years. Remember, it's 10 years we do this, right? Like the first year was very, very hard to get a response. The second year, the second year was a little bit easier. Now today, we benefit from the reputation of Valsoft. We benefit that, like, Valsoft has bought 130 plus companies, so people take us seriously when there's an outreach from us, and more deals go through brokers nowadays. The brokers tend to know us. Probably their firm has sold a company to us in the past, so they'll show it to us too, right? So you gotta get to know the founders, and they gotta believe that you're gonna treat their employees well and their customers well, and that if they do business with you, they're gonna have a good outcome.
Makes total sense. So I guess pivoting a bit, I would imagine the vast majority of your portfolio is not AI native, depending on where you draw the line. Now, maybe they have become AI native in a way, but what are the biggest, risks, challenges, ways you're approaching things differently in this era
It's an interesting time, eh? It's an interesting time
for everyone, right?
it's a very interesting time to be alive. A very fun era we are in, an era full of opportunity, I think, and risks, right? I think you can't ignore AI in doing your business, and you gotta, like, sort of have a bigger view, a longer term view of things. Some businesses are gonna grow a lot, because they're gonna tackle a bigger percentage of the customer's workflow. So they're gonna be able to uh, grab a bigger part of the economics. And then there's businesses that are like just not gonna exist, I think, or they have much lower terminal value associated to them, right? But in general, for systems of record, I don't know. I see things probably more positively than most in terms of the potential for growth and customer capturing a bigger percentage of the customers' workflow.
Do you think the risk is bigger for maybe businesses that are in, kind of smaller products in smaller markets? I mean, maybe even highest for businesses that are too subscale for you to acquire. But I guess in terms of your internal rubric around, okay, where does AI pose a risk?
Businesses that have like a large amount of tech debt, like businesses that cannot adapt to the new reality, they're going to be challenged a little bit, right? Because like things are going to start to move faster. Like the rate at which technology will be produced is going to be significantly higher in the next 10 years than it was in the last 10. Sort of like you could still kind of like make it work over the last 10 years. Despite that, I think in the next 10 years, what's going to be built, if you're not set up in a way where you could build on top of your current stack or whatnot, like it's going to be difficult for you to what's going to happen is your customers are going to become at a competitive disadvantage, right? And then they're going to want to switch their software solution.
Yep. Do you think about that R&D budget changing? Like, do you suggest or model out a higher R&D budget for AI experimentation?
Yeah, on one side, it's gonna be lower R&D budget because you could do more with less if you're set up properly and if you have the right infrastructure to start with. And if you don't, well, then you better get there, I think, quickly, else you're gonna have a little bit of a problem as technology iterates faster, right?
So Sam, my kind of view of this whole, obviously all three of us spend all of our time in like vertical software, vertical AI, right? And so this question comes up all the time. I think on like All In podcast 2 years ago, Dave Friedberg said, "Oh, it's the death of vertical SaaS because the end customers are just going to build their own kind of AI tooling." So that's the extreme side. The you know kind of the other side of it is if you're the system of record, you actually have potentially the most advantageous kind of spot to be in, assuming that you adapt correctly and you kind of transform these things into, more and more kind of AI tooling and less like electronic filing cabinets like they've been. Where do you see kind of the world going and what's like Valsoft's kind of war room position on this?
I think like horizontal type of solutions are more a risk than vertical solutions. So I think vertical solutions have a lot of like these vertical companies are not just software providers; they're also they integrate to all kinds of things that are specific to a company. They have experts in the vertical working at the company that support and service the customers, that act like consultants for the customers. They have very specific workflows. And being a customer of a vertical market software companies gives the end customer a lot of intel into the industry and the best practices and whatnot through their software. So this like a one for one software thing that people are talking about, I don't believe in that. I don't think that's anywhere near. And I think the percentage of the cost base that software represents to an end market does not like saving that does not justify losing the expertise that dealing with an external organization that sees hundreds of customers gives you as an end customer, right? So I don't see that. I think very thin pieces of software could certainly be a risk, but like the systems of record, the more integrated pieces of software, I think have a good future as long as they're able to adapt, right? Like if you're let's say servicing let's give an example of the revenue cycle management industry, okay? And revenue cycle management, you had an ERP that you sell to these customers, and your ERP is legacy, and like the new features that AI enables, which like you could cut a lot of the workflow of the agents doing the RCM with the new technology that's out there today. If you're not able to provide that, you're gonna start losing market share. But if you're able to do it, your customers are gonna see a lot of value in what you do, and then what else can you do for us? And you're likely to make a lot more money down the line than you are today.
Do you guys push down a strategy at all around like not letting kind of AI upstarts like interact with the systems? Or I mean, I've seen it both ways. Like I've, kind of pre my last business becoming the system of record, we would work with some system of records that just made it hell to try to integrate or connect with. Others would be very open. That's like a very challenging question to answer in an AI age. Do you guys, is that just totally delegated at the company level, or how do you guys think about that?
This is not something that comes from HQ. It's not something that we have, like, we're completely decentralized, right? We have a GM that manages a business, and it's usually the old founder or somebody at the company that's like has a lot of vertical expertise, and they make the decisions for that company at vertical. But that being said, like, we need everybody that manages a business for us to be aware who's getting funded in their industry, and what's coming up in their industry, and who's asking for an integration. If somebody's asking for an integration, you should ask yourself, okay, what's happening there? Maybe I should be doing this. Or in some cases, this is something I won't be able to do, and my customers are going to need it. If I want to give them the best service, I got to integrate, right? But this is, every one of our companies is facing these decisions at the moment.
Yeah. My favorite part about your business is you have this like incredible sandbox of 130 vertical SaaS businesses that you can do like anything with, right? Like I know payments has been a huge aspect. Like beyond payments, is there anything that you can point to that's been like, man, this has just been amazing across our whole portfolio or majority?
Look, do you mean like a strategy?
What we do?
Yeah, like a product strategy.
We run fully decentralized, right? So like all these businesses are managed. None of them are managed by HQ. Everything is managed by a GM, and our role is to build an ecosystem within which vertical market software companies can thrive, right? So things that we could do, but maybe each independent company is too subscale to do on their own, and then through the ecosystem, we could give it as a resource to the end companies if they wish, if they want, right? So an example of that is our global delivery centers. So we have, these global delivery centers staffed with people that understand how to code using the latest technology, right? People that could augment the capacity of your internal team very significantly. So that's been extremely successful for us. That's probably the area where we bring the most value, because we could augment the product capacity of the end company significantly. Payments has been very successful. And now the latest thing is we have our AI lab internally, where we basically have a core platform around which each of our companies could build, let's say, voice agents very easily for their end customers. So we have like the core platform, and they have to train it on what they need, but it's relatively easy and we've seen people launching them, or our GMs launching them in several different industries with success. And then we have other type of AI solutions that we're launching like that could apply everywhere, right? So anything that involves reading documents or enabling better efficiency of a white collar worker, we're working on it somewhere, right?
Sam, I to Luke's point, you have this incredible perspective. I'm sure that you have companies across kind of all touching on all sectors, but are there certain verticals where you just know based on experience you're going to approach with more skepticism, and other sectors where you say, man, I wish I could find more companies in this space?
Yeah, for us, the bigger the vertical, the less interesting to us it is usually. Uh, Small vertical lend themselves better to a rational environment, right? Bigger verticals could attract a lot of money that is chasing exponential returns, which they'll get, 1 in 50 times, but the other 49 times, there's a lot of money that competes with us irrationally, right? So we try to stick to like the smaller verticals where you need less of a massive investment to protect your market share and to be competitive, right? If you're playing in the very large spaces, there's a lot of very able entrepreneurs and very large money pools chasing these areas because there's a lot of the large TAM and there's a lot of profits to be had, right?
Sam's got to jump on a plane here, so I'll ask one quick final one, and then Nick, if you want to do a final one too. You guys are at 700 million of ARR. It's 10 years
of revenue, 750 something million.
See, yeah. I love Sam because he thinks a lot in profit, which is atypical for a SaaS founder, which you should. So listeners, think about profit like Sam does. But 700 million in ARR, what's next for you guys? Like, what do the next 10 years look like? You want to take this thing public? Like, you obviously can.
In the next 10 years, I think I'm of the personal belief that our opportunity is great. We own a lot of systems of record, and we're in a good position in the market to take advantage of what's coming. I think we're going to capture a bigger percentage of the customer workflows enabled by the new tech that's available to us. AI is sort of another continuation of the technology cycle that began decades ago. When the GUI came out, a lot of companies went out of business, and a lot of companies grew a lot. When cloud came out, a lot of companies sort of became legacy, and a lot of companies grew. When mobility came out, there was a wave of value creation. And I think now with large language models and the productivity gains that they enable will lead to large waves of value creation. It's like, you got to think, it's like when railroads came out, a lot of businesses were enabled by that, like restaurants around the railroads stops started popping up. You got to think, what type of stuff is this going to enable? And you got to get there early in order to protect and expand your market share over the coming years.
So just keep growing, baby. That's the focus.
Keep growing, hopefully.
Growth is the medicine. Okay, final question for you, Sam. If I were, founder, let's just, kind of addressing all the founders that are listening, and they're, maybe they've just hit profitability or they have their first million EBITDA. How should they think about Valsoft? Like, when should they talk to you guys? How should they connect?
Yeah, I mean, like Valsoft, hit us up on the website or hit me up on LinkedIn, and I'll take the call, and we'll get to know each other. And when the time is right, we could partner up, and hopefully, I think we have a great ecosystem for vertical market software companies to do very good things. And I think there's been over. There's a lot of people that have built fortunes at Valsoft, getting into our equity and seeing that compound at a very high rate over time. And I think it's just getting started.
Well, Sam, thank you, my friend. I appreciate it. You are a legend in this space, and excited to see what you do over the next decade.
You're the legend, guys. Thank you very much for having me. I really appreciate it.
Awesome, man.
Thanks so much, Sam.
Thanks. Bye, man. All right. Well, Sam is such a badass. That was a ton of fun. I could talk to him for hours about their model. I think it's very, very interesting, so fascinating. And I think in an AI era, it's going to be, it's either going to evolve and make them so much more valuable, and they're going to like really take advantage of it, or it can be like a serious kind of risk. And so it'd be interesting to see kind of how the aggregators react to, AI and vertical AI upstarts that are coming into their space. So will be fun to watch.
100%.
That's our podcast today. So I appreciate everybody hopping on. Nick and I always enjoyed jamming out with you all. And as always, just a really quick shout out to Paraffin, our partners who make verticals possible. If you haven't heard of Paraffin, go check them out. provide ready to launch financial products, really focus exclusively on vertical SaaS companies. All of these expand TAM, drive revenue, boost retention. And so just an incredible company. So if you want your merchants to grow with you, you need to know Paraffin. So shout out to them, and we'll see you all next week. Looking forward to it.
Can't wait. Thanks, everyone. See you soon.
Thanks.